Okay, good afternoon, everyone. We'll get started in just a moment. I'm just letting a few more attendees in, and then we'll get started. All right, let's get going. So I'm going to just share my screen with everyone, and hopefully you should all be able to see PowerPoint slide. Just a little bit of housekeeping before I get started. Across the top of everyone's screens, you should be able to see a chat option. So if you've got any questions or anything, pop it in there. There is actually a Q&A section as well. So feel free as we go through today's presentation just to jump in and ask any questions that you've got. I'll cover those all off at the end, and we'll go from there. So for those of you who don't know me, my name's Andrew Grinsell. I'm the head of wealth here at Cooee Wealth Partners. Most of you who I can see are in the meeting room at the moment, I have met with personally, but yeah, for those who don't know me, I lead the team of wealth partners that we have here at Cooee, and also sit on the investment committee for our portfolio construction. So last year, we ran this presentation. The feedback was overwhelmingly positive, so I'm pretty excited to be able to come back and present it again. As we look into 2025, there really is a lot going on in the investment world that does demand close attention. So obviously, we've got Donald Trump returning to the White House. There will be shifts in US economic and foreign policy that will have global market implications. Closer to home, we've got the trajectory of interest rates and inflation. The Reserve Bank obviously trying to balance economic growth with price stability, and everyone's sort of looking forward to what might happen next week with interest rates. On top of that, we've also got geopolitical risks. We've got energy concerns. We've got tensions in trade corridors. All of these sort of things do reshape the opportunity, but also the risks that we have across different sectors. And of course, there's the advancements in technology with the continued rise of AI. So in today's webinar, we'll touch on some of these themes and a bit more, and go from there. So let's get started. Before we go any further, I do have to just remind everyone that today's information shared is for general information only. Should not be considered personal advice. So if you are after some personal advice, please reach out to our wealth partners. And of course, the disclaimer you've all heard before, that past performance is not a indicator of future results, and all investments do carry risk, including that of potential capital loss. All right, so I think we sort of touched on the agenda already, but I will start with a review of what happened in 2024. We'll look at the 2025 outlook. We'll look at the key themes as well, and then have a look at what does it actually mean for portfolio positioning and what are we doing for our clients. So let's start with looking at 2024 before we jump into 2025. So look, 2024 definitely kept us on our toes. There were some surprises, both good and not so good. It is worth breaking it down before we dive into what's next. So if you did attend last year's webinar, you'll probably remember a lot of the talk was about what was expected in 2024 was all about big interest rate cuts in the US and around the world. Well, that didn't really happen. The US and Europe did receive a few interest rate cuts, but not really the major interest rate cuts that everyone was expecting. We didn't get any in Australia. That being said, the US economy still managed to avoid any sort of hard economic crash. It's what they're calling a soft landing. As I said, over here in Australia, the Reserve Bank really just decided to keep things steady. But by the end of the year, we did start to see some hints that the RBA might ease off soon. On the political side of things, obviously Trump. So one of the biggest headlines was Donald Trump winning the US election. Now, his win is expected to mean more pro-business policies, which has markets feeling optimistic. Meanwhile, over in China, they sort of tried to roll out some stimulus measures, but it didn't really quite hit the mark. So that left global growth being a bit slower than what many had hoped for. We'll dive deeper into these points just a little bit later. On the market side of things, obviously US stocks had a solid year thanks largely to technology and AI more specifically. Some of that did spill over into Australia. Our relatively small tech sector actually produced a 49% return in 2024. Banks also had a really big year. So names like CBA and Westpac saw their earnings get bumped up and investors loved it. So one thing that we do need to note is that in late 2024, earning revisions, so announcements from companies around their earnings, really came back as being one of the key market movers in terms of actually driving stock prices. So in other words, stocks that had their profit forecasts upgraded did really well. Those who had downgrades did really poorly. Now that seems quite logical, but for quite a period of time, that logic wasn't really there. So look, that's sort of what we saw in 2024. It was a year of economic twists, political shakeups, big wins in tech and bank stocks. Hopefully the lessons for 2024 help guide us for 2025. So I'm looking forward to diving into more of what to expect for the year to come. I do want to have a look though at just a little bit more detail around how the various asset classes did perform in 2024. If we look here on this table, this is from Morningstar. It actually gives us a bit of data around how the major asset classes returned. What we'll do is we'll have a look over on the right-hand side of it, so the 2024 column, starting from the bottom and working our way up. Obviously, international bonds managed a very modest 1.8% return. That was the worst of it, so we didn't really see any losses in any asset class last year. The reason for international bonds probably not performing as well last year as was expected was interest rates stayed higher than was expected. So falling rates, good for bonds, rising rates, not so good for bonds, which might sound counterintuitive, but it's largely due to the function of if you go and buy a bond, it has a fixed rate of return. If interest rates fall, the income you're getting on your bond that you bought before interest rates came down, it's quite attractive. So you can probably sell it in the market above what you paid for it. But if interest rates go up, what you're holding might not really help. So it's just something we've got to bear in mind. Now, Australian bonds also had minimal returns, really underscoring the challenges faced by traditional fixed income investments. As I said, we didn't get the interest rate cuts that would have given a bit of a boost to bonds. But look, in bonds, the market overall did see quite a wide range of performance. So it really depends on the type of bonds that were held. So within our portfolios, we had a much higher allocation to the likes of private credit and high yield. High yield bonds actually returned 9.7% last year. So that was driven by a lot of corporate refinancing activity. In contrast, emerging market debt had negative returns in the fourth quarter. So that's borrowings by companies and governments in the developing world, mainly due to geopolitical risks and also a stronger US dollar. Cash, more modest at about 4.5%, reaffirming its role as a low growth but a stable option. Then looking at US equities in gold at the top, 37.8% for the year. So that's two back-to-back years of really, really impressive returns, largely driven by tech and AI leadership. Obviously, I'll touch on Australian shares in blue at that 18.5% return. Pretty strong, just not quite US strong. So we are seeing equities across most regions now at elevated levels. So we do have a bit of caution. And look, last but not least, I'll just touch on international property. It was the best performer way back in 2021. I should say way back, it's only 3 years ago, with a 37.2% return. But last year, a bit more modest at 11.9%. Those higher interest rates typically aren't good for real estate because there's borrowings, higher interest rate, more expenses, less profit to distribute to investors. It's really what it comes from. So, look, I think the main thing here is the importance of diversification. Look, over the last 2 years, you would have done pretty well if you just picked US stock, but look, it's not always the case. 2022, we can see US shares were down 12.2%. The last decade, however, has been a very good run for US shares. All right, so look, I don't think any market commentary would be complete without a discussion around Donald Trump and the Republican Party in the US. So what impact will his administration have on economic growth and inflation? It's a critical question, and really the answer is still quite unclear. So on one hand, President Trump, I should now say, I wrote this before the inauguration. Some of President Trump's proposed policies could stimulate growth and lower inflation over time, but look, others could have the opposite effect. So let's break it down a little bit. We'll start with the positives. So Trump is broadly pro-business, which could boost economic activity by unleashing the animal spirits that really drive investment and innovation. If the corporate and personal income tax tax cuts that are set to expire in 2025 are permanently extended, that would further support growth. Similarly, reducing excessive regulation, if done thoughtfully, could cut red tape, encouraging competition and lower prices over the long term. Trump also aims to ramp up US oil and gas production, which could reduce energy costs and make energy-intensive sectors more competitive. However, it's important that this push doesn't completely phase out green energy initiatives, which are critical for the future. So one of the other growth-orientated proposals involves the Department of Government Efficiency, DOGE, which aims to streamline government spending. While the $2 million in promised tax cuts is unlikely, even $200 billion in savings could reduce inefficiencies and really free up resources for growth. Look, lastly, on the positives, before we move on to some of the challenges, Trump's growing rapport with tech leaders could turbocharge industries with exposure to artificial intelligence, the robotics and biomedical research. So the administration really does seem ready to support these sectors by cutting regulatory hurdles and also fostering innovation, but it does come with a catch. So these benefits depend on time and balance. Some of Trump's policies could actually stoke inflation and hurt growth. High tariffs, trade wars, decoupling from China. These are all examples of things that can push inflation up and hurt economic growth. These actions create supply chain disruptions that raise costs for businesses and consumers, and the impact will depend on how far they actually take these measures. Additionally, we've got stricter immigration policies and mass deportations that could worsen what we already have in labour shortages in key sectors. That pushes wages up, that pushes up inflation, that hurts growth. Tax cuts. If they're made permanent without offsetting revenue measures, public debt in the United States could surge by as much as $8 trillion over the next decade. That level of debt growth would crowd out investment, that would increase long-term interest rates, and it would fuel inflation. So, and also we're talking about a disorderly effort to weaken the US dollar to make it more competitive, which really would rattle financial markets and increase inflation further. Likewise, any perceived or real threat to the Federal Reserve's independence would also heighten inflation expectations and also actual inflation. We've also got geopolitical factors with another layer of uncertainty. Trump might ease the risks that we're seeing with Russia, Ukraine, and the Middle East. Broader economic conflict with China, though, could fragment the global economy and have lasting consequences for growth and inflation. So where does it leave us? With the impact of Trump's administration, the economic impact there, it's really going to depend on whether the positive policies outweigh the negatives, because there are both sides of it. Fortunately, there are several guardrails that could prevent the most damaging proposals from taking effect. One of those is market discipline. Policies that fuel inflation or government deficits will likely lead to higher long-term interest rates, and it could also trigger a stock market correction. Trump views the stock market as a key measure of his success. So these measures, and if the stock market reacts negatively, could deter him from any overly risky economic moves. We've also got the Federal Reserve being independent. It's a crucial check on inflationary policy. So even the influence of Trump's appointees to the Federal Reserve, who generally understand the economy, may help moderate some of the more extreme proposals. Finally, before we move on from Trump, a slim Republican majority in the House of Representatives means Trump cannot rely on full party support for policies that would significantly add to public debt. So if the administration managed to avoid its most radical policies, the economic outlook could be relatively balanced, but growth is still likely to be slow in 2024, could exceed potential, but still likely to be slow. Inflation might edge further away from where the Federal Reserve wants to see it. So look, in short, unless there's a major geopolitical shock, the year ahead should be relatively sort of benign for the US economy. All right, moving on from that, I want to talk quickly about artificial intelligence, obviously hot topic, what's going on in 2025. Obviously, stepping up big time. It's moving beyond just niche applications like chatbots and image recognition. It's now really becoming a core part of how industries operate. It's streamlining work, it's boosting productivity, it's improving decision making. For example, in manufacturing, AI-powered automation is making production faster, smoother, cheaper. It's using real-time analytics to really optimize the processes. In healthcare, AI is helping doctors catch issues earlier, creating personalized treatment plans. It's improving patient outcomes. It's really like having a digital assistant with superhuman pattern recognition capabilities, which is great. In financial services, our industry, it's obviously being used to predict market trends, manage risk, and detect fraud faster than ever. But it's not just about software. Infrastructure is becoming a big part of the story too. Over the next few years, companies are expected to invest $1.5 trillion into data centers and power generation. Half of that's just to power AI. So these systems need serious horsepower. AI is growing energy demands, sustainable and scalable energy solutions are critical. All right, so look, long story short, AI is going from something kind of experimental to something essential. It's transforming industries, reshaping economies, and that's really just the beginning. Obviously, with our AI booming, and as I just said, it's got energy implications. So after 2 years of rapid growth and investment, it's clear that AI is not just hype; it's here to stay. It's driving profit, transforming industries. As I said, there's a catch. All this innovation comes with a really hefty energy bill. So data centers are power hungry. They use far more electricity than traditional data centers. So that's the AI ones use more data than a traditional data center. In fact, some reports suggest that massive power demands have actually started to distort local residential power grids. And as AI continues to expand, data center energy consumption is set to skyrocket over the next decade. So that's where energy infrastructure really is becoming critical. The world's really facing a balancing act, powering AI while still pursuing climate goals and decarbonisation. Renewable energy is part of the solution. Nuclear power is gaining momentum as well. Why? Look, honestly, it's a clean, it's reliable, and it's the second largest source of low carbon electricity globally, and it provides the constant uptime that AI infrastructure needs. You see the chart on the screen on the left-hand side that there's been a lot of investment going into this space. A lot of that's coming from the major tech players. So in 2024, Microsoft, Amazon, and Google all made direct investments into nuclear power. So move into 2025, there's more momentum for corporate and government partnerships to help support it. So it does open up opportunities for investment across the energy value chain. In short, really, there's a battle for power that's on, and the future of AI could very well be powered by nuclear and other sustainable solutions. All right. Now, let's get a little bit more into around what this actually means for investors and how it works for portfolio construction. So obviously, most of us have heard know that equities perform well in the long term. You can see on the chart here, Australian equities going back to 1920. So we've got over 100 years of data. Basically says, look, yes, there's ups, there's downs, but share prices always go up over the long term. It's not just an Australian story. Here's the United States, again, back to 1920. Some big ups and downs, but, massive returns over the long term. Just be careful of the scale on the left-hand side. It's not just basically saying it's taken 100 years to quadruple. It's gone from, if you invested $10, you'd now actually have closer to 5,000 over that time frame. United Kingdom, again, very similar. So they're sort of the major markets. We can see share markets really well over the long term, but it's not always the case. Let's have a look at what happened with Japan. So Japanese investors who decided to put money into the market back in 1990 probably only just found that their investments have recovered to a new high after 34 years. And that's really just due to the value of the Nikkei having quadrupled in the last 10 years. Before that, it was a pretty horror story for Japanese. So look, we should say that equities usually perform quite well in the long run, but I just want to make the point here that it's not always the case. So hints at why it makes sense to diversify into more than one market. Sometimes things can go horribly wrong at home, as Japanese investors found out at their cost. Could this happen here, or is it really just a Japanese problem? All right. So as we touched on earlier, US shares, really strong performer. However, there's been some big downturns along the way. Drops of more than 20% every few years and more than 40% on quite a few occasions. So you can see on the chart here, whenever there's been a recession, typically there's been a drop in the markets. And we see here, like the global financial crisis, more than a 50% correction in the markets. That's not an anomaly. We saw a very similar drop in the tech wreck, which was that sort of 99, 2000 era as well. And again in the 70s. So look, 20% drops, they happen all the time. 40% or more has happened a few times as well. So look, some investors are going to sit back and go, that's fine over the long run. I'm happy with that. But a lot of other investors just aren't going to be happy to ride those ups and downs. So again, it just comes back to why we need a well-diversified portfolio that really smooths out these ups and downs. So, how do we actually do that at Cooee? How do we put together a diversified portfolio? One option might be to have a look at allocating more to asset classes that have recently performed very well. Just got a comment there from a client saying that they can't see the presentation. I wouldn't mind just if someone else could jump into the chat and just tell me if you can or can't see it. That would be helpful. So if you just go to chat and tell me you can, I've got thumbs up. So Georgie, it sounds like it might be a challenge on your side. I'm not too sure there. I'll have to carry on. I'm getting a lot of yeses to everyone else. All right. So where was I? Okay. One way we could look at constructing a portfolio, we could go and have a look at past returns and just say, US equities have done well the last 10 years. Let's just keep going. Now, the situation, however, is that past performance really isn't a reliable past performance is not a reliable indicator of future performance. And this chart really gives us a good explanation as to why we always say that. So in blue, we have the forecast returns for the US market that's based on taking the average annual return over the last 20 years and just assuming that's going to keep happening for the next, into the future, right? In orange, we have the actual return. So that's what actually happened over a rolling 10-year period. So what it's telling us is that if past returns really were a reliable indicator of future returns, the blue and orange lines would move mostly in tandem. But what we can see here is they don't. So using this method, what we can see is that when forecast returns are high, so if you extrapolate past history and think that's going to happen into the future, actually it doesn't end up happening that way. They tend to be low. So it actually sort of works in the opposite direction. So to put it another way, or put it bluntly, past performance does not provide an indicator of future performance. In fact, it moves in opposite directions. High returns are usually followed by low returns. Low returns are then usually followed by high returns. So using past performance as a guide, it's a bad idea. This is why our clients will often see us recommending the sale of investments that have performed really well. Just today, the investment committee's decided that we're going to remove GDX, which is the Van Eck Gold Miners, which is using the Van Eck Gold Miners ETF. We've decided to remove that from our model portfolios. You might look at it and go, it's up 46% for the last 12 months. Why would you get rid of it? Because it's had a great run. It's now expensive. We want to move on to something cheaper and actually has better value. All right. So same pattern also happens in Australia. In fact, it happens in every market around the world. So after a long period of really high returns, everyone starts to feel confident. Our instincts start to tell us to invest. They tell us to be positive. And then after a long period of poor returns, it's quite the opposite. At these times, most people lack confidence and are reluctant to invest. So this is one of the reasons why most people do find investing difficult, mainly because our normal human behavioural biases are all wrong when it comes to investing. All right, so look, is there a better way to do it? Yes, there is. So what we do is we look at the fundamental value of assets, and one way to do that is, let's start by thinking about a fake company I've made up. Let's very creatively call it ABC. Let's say ABC earns a profit of $1 for every share that it has on issue, and these shares are currently trading in the share market at $16 a share. This means that the market is willing to go and buy the shares at $16 for every dollar of earnings. So in the investment world, we call this a price to earnings ratio. The price relative to the earnings would be $16. Now, the only way for the share price to increase is earnings could go up. If earnings went up to $2, we might pay $32 for the shares because we're still getting that 16 times to 1 ratio on price versus earnings. Alternatively, the market might be saying, well, we're willing to pay more for every dollar of earnings. They might say, I'm willing to pay $20 to get a dollar of earnings. That's really the key driver of share prices. Let's have a look at where those PE ratios actually sit at the moment. And I'm a little bit mindful of the fact I might be getting a bit technical here, but it's kind of a necessity. So over the last 2 years, as we said, we've seen back-to-back double-digit returns in most major asset classes. In fact, the US market just had its best 2-year run since 1998, which is great news for investors in that market. But now everyone's asking the big question, how much are we really willing to pay for future growth? So valuations now coming back to being front and center. The US equity market's current price to earnings ratio is trading above its 90th percentile. So what that means is that compared to history, stock prices are very expensive right now. So if you tracked the market's PE ratio for over the last 25 years and you ranked all those PE values from the lowest to the highest, today's number would be higher than 90% of all of that data set that you've taken. So this suggests that investors are paying much more than what's usual for a dollar of earnings. Now, it means that the market's either overheated or there's a huge expectation that earnings are going to increase. So even if you take the Magnificent Seven, those big name tech giants out of there, global valuations still look high. But regions like Europe, Japan, and emerging markets are much more reasonably priced, as we can see on the chart here. All right, so we've just spoken about it. Where do returns come from? Income and dividends, pretty straightforward. You get paid out a share of the profits or you get interest on your bonds. Growth in profits, so can the company increase its earnings? And then the changes in sentiment, which is the PE ratio. How much are people actually, how positive are people? How much are they willing to pay for the underlying earnings? All right, so what this then does is it gives us another approach to forecasting that's actually worked over past periods in, say, the United States. So look, it's not perfect, but it's a whole lot better than the charts I showed you before with the blue and the orange that diverge. So most importantly for us, it identifies periods of high returns and it identifies periods of very low returns. You'll see that the orange and blue lines are much more closely aligned in this chart than what we saw under the alternate method of using past returns to predict future returns. There's a big gap at the moment, but if you have a look at the chart, whenever a gap has emerged, it's typically snapped back by way of a decline in prices or returns. All right, so that's the US. Australian shares, it's even a better match. As I said, it identifies when we should have periods of high returns and periods of low returns. All right, let's just get a little bit more focused around each of the major asset classes and their forecasts using this same methodology. Australian share market, look, it continues to run hot, seemingly ignoring many of the uncertainties in the current environment. There's questions around the impact of Trump's policies on China and then Australian exporters in turn. You know, when's the RBA going to declare that the battle with inflation's won and start to cut interest rates? I think I've been asked that question half a dozen times this week. I'll just touch on it briefly. Money markets are pricing in a 90% probability of interest rate cuts next week. I think it's closer to a 50-50 probability. The headline inflation number looks good, looks well in control in the low twos. However, it's artificially manipulated by the fact that there's an energy subsidy, which is temporary. Take that out of it, inflation's actually still sitting above 3%. So I think it's more a 50-50 chance rather than a 90% probability to move. I know that sounds like I'm sitting on the fence though, but I truly am undecided one way or the other. So, you know, question it raises though is the RBA potentially going to wait too long and turn the current slowdown into a full-blown recession, or will it cut interest rates too fast and then have to fight a second and nastier battle with inflation that could pop up again, say 2026, 2027? Most central bank governors around the world want to make sure they don't have a repeat of the 1970s where it was thought that inflation was under control. It was getting down to that 3% mark. Everyone started cutting interest rates. They got it wrong. Then interest rates went to 17%. So really, they want to make sure that doesn't happen. You've got to make sure inflation's well and truly under control. Let's look across the ASX, so the Australian share market. Current trailing dividend yield across Australian shares is 4.8% per annum. That's when you add in the franking credits, which are about 1% a year. So that's the tax the company's already prepaid that you get a tax credit for as an investor. Look, it's lower than this time last year, but it still provides us with a good starting point. Expected growth in earnings per share is strong, but the price to earnings ratios are a little bit high. So we do expect that to drift lower. So that takes a bit of value out of the market. So it sets the scene, unfortunately, for a fairly low return forecast of about 5.6% per annum for the next 10 years. We're particularly concerned about the share prices of major banks. And if we look at the three factors that determine prices, share prices, that's that being yield, earnings per share growth, and price to earnings ratio, there are some red flags. So in the banks, yields are not too bad at 5.7%, so that's above the market, but earnings or profit growth is expected to fall, mainly due to more competition and also regulator, APRA, mandating increase in capital requirements. So realistically, banks need to fall back to a PE ratio of about 12.9 to give investors a suitable level of risk versus return. CBA is currently trading at 28 times earnings, so more than double what is deemed to be an acceptable price to earnings ratio. So it really is just hard to see how that's sustainable. And it's even harder to see how CBA could grow its earnings enough to justify that kind of a PE ratio. In our own model portfolios that we run for clients, we recognised this late last year. We took the Spider MSCI Australia Select High Dividend Yield Fund out of the portfolios. It had 45% weighting to the banks. We've replaced it with the Macquarie Australian Active Equity ETF. It's a lot lower at 33% weighting to the banks. Still got bank exposure, but not quite to that high level. Additionally, we've got exposure to resources, which some of you have probably noticed has got the highest forecast return at 9.3%. So in addition to the Macquarie Fund being the core component, we've gone and put the Spider S&P ASX 200 resources fund in alongside that to just tilt the portfolio more towards having that resources exposure for clients. And lastly, we complement that with a fund called the VanEck Australian Equal Weight ETF. It's got less than 20% invested in financials. Its portfolio probably most closely resembles what you see in that column there titled The Rest. All right, let's jump into the United States. Current share market pricing, as I sort of touched on before, it's priced to perfection. It's pricing in all the good bits, 100% ignoring all of the bad bits. The market's not even asking for a premium for uncertainty. So look, positive momentum could continue. History indicates though that there's limited room for further gains at current valuations. So look, the chart on screen does help illustrate that point. It uses something called the cyclically adjusted PE ratio, CAPE ratio, cyclically adjusted price to earnings ratio. It's a full bit of a mouthful. Look, simply, it's a measure of if the stock market's overvalued or undervalued. It compares the prices of stocks to their average profit over the last 10 years and adjusts it for inflation. A high CAPE ratio means stocks are expensive. Low CAPE ratio means stocks are cheap. So the chart shows that lower CAPE ratios, so the CAPE ratios on the bottom side there, typically the lower the CAPE ratio, the higher the returns, right? When the CAPE ratio has been below 10, in most cases, the subsequent or the returns over the next 10 years have been positive. That's all the blue dots. So we look here, very much scattered in good return territory. As the CAPE ratio increases, the dots start to fall down. Some of them start to drift below the blue line. By the time we get to the solid black dotted line or dashed line there, which is where we are today, history shows us over the last 143 years, there hasn't been an instance where the US stock market has managed to provide positive inflation-adjusted returns over the following decade. So current valuations combined with the economic outlook really do present a compelling case for us to take some chips off the table in the States. The Cooee Wealth Partners model portfolios are very, very underweight US equities, and they've been progressively pulled down over the last couple of years. Obviously, that hurt performance a bit last year, but we picked up for it in other areas. Look, outside of the US, we look at Japan. It's the second largest stock market in the world. Last year, it had a bit of a rocky period in the middle of the year. Interest rates rose unexpectedly, but it bounced back. Look, Japanese stocks returned 5.4%, or they're expected to return about 5.4% per annum over the next decade. That's a bit better than the global average expectation of 2.9. It's still not super exciting, but hey, it's better than what the US is sort of doing it to it. So look, what's driving it really is Japan's economy is growing steadily. It's got higher wages, consumers are spending. A weak yen also brings a lot of tourists back. You might have seen a lot of news articles at the moment around Japanese really struggling with the tourism influx and places being overrun, but it does bring money into the economy. The other thing is Japanese companies are really just improving how they operate. So they're cutting cross ownerships, they're increasing dividends, they're buying back shares. It's really good for investors. At the moment, we don't have any direct exposure to Japan, but it's definitely on the radar for us to look at. We're continuing our research in that area. In Europe and the UK, things have been a bit tougher. Growth's weak. Political instability in places like Germany and France are creating challenges. But that said, stocks in those regions are so much cheaper than the US. Keep some investors away, but there's opportunities in materials, consumer staples, luxury goods as well. So look, while the US markets have led recently, we do see Japan and Europe as offering attractive opportunities for long-term investors, especially in those sectors that have got really strong fundamentals and better value. All right, emerging markets. So showing a bit of promise for 2025. So look, last year, the MSCI Emerging Markets Index delivered a solid 18.5% return. That's in Australian dollar terms. Looking ahead, we expect that positive momentum to continue, really driven by strong economic fundamentals. Currently, emerging markets, they're attractively valued, but many investors remain underexposed. The underperformance relative to or the underallocation, I should say, is largely due to the aggressive fiscal spending and accommodative central bank policies in developed markets, which is grabbing a lot of the headlines and overshadowing emerging markets and sending more money to like the US. But look, we think the landscape's shifting. Developed countries are really grappling with increasing budget deficits, persistent inflation. Central banks have been quite cautious, but in contrast, in emerging markets, they've got pretty healthy fiscal deficits. They've got manageable debt levels, and the corporates are in a really strong position. So, additionally, if we see any sort of weakening of the US dollar in 2025, influenced by federal debt and other uncertainties around government policy, that adds further benefit to returns for countries like China, Indonesia, Vietnam, and presents some pretty significant opportunities. And these countries have had decades of economic reforms. They've got improved infrastructure. Their manufacturing capabilities are getting better. There's a growing middle class in these nations, and they really aspire to a higher standard of living. So it does quite well position them for rapid growth, even in a sluggish global economy. So. And lastly, just want to touch on China. Look, it's well known by most people that there's some structural challenges. There's been some recent policy shifts that have led to some price increases in property in the major cities. Monetary policies has become a bit more accommodative, and we're expecting a bit more further fiscal relaxation to create a bit more of a conducive environment for investors. So look, really overall, we think emerging markets are poised for a bit of a resurgence in 2025 from investors, with the attractive valuations and pretty good growth prospects. So it does present a compelling opportunity for investors who are seeking some diversification as well. All right, fixed income. Over the last year, obviously, major central banks like the US Federal Reserve and the European Central Bank shifted towards lowering rates after some aggressive hikes in 2022, 2023. Look, it's creating a more favourable environment for fixed income investing. The yields are attractive, particularly in core fixed income. We look at US Treasury bonds and other high quality bonds that are offering yields that provide competitive returns, but more importantly, downside protection. So the combination's making bonds more appealing to both institutional and retail investors. Even with economic headwinds, inflation and a bit of slower growth, bonds are pretty well positioned to help manage these risks for clients in portfolios. We look at core fixed income investments to offer really sort of solid long-term returns while balancing out the volatility we see in equities. In our portfolios, as I said, we're looking at taking profit on the gold miners and moving that more to the sort of the fixed income area. Additionally, we've got quite a bit going on in credit markets and real asset lending. It's gaining a lot of traction at the moment. There are a few investment opportunities emerging in this space that we're very concerned about, that clients have brought to us, but there's also some very good opportunities. It's just a matter of being very selective with where we go to. Those areas really do give us some opportunity to get higher yields. We look at like the Metrics Opportunity Trust, getting 8 to 10% per annum cash flow off that. And we're not taking on excessive risk. So we like things like that. It's less risk than equities, but with a similar forecast expected return or even higher, makes for a compelling argument to be in that space. A couple of other names that we've got in there. We've got the VanEck Bentham Global Capital Securities ETF and also the Global X USD High Yield Bond ETF in there as well. Look, overall, the reason for bonds is stability. Historically, bonds give us a negative correlation to stocks. Simple terms, when stocks fall, bonds go up. That helps really reduce the volatility in portfolios and smooth out the returns. And capital preservation. So the high quality bonds like government securities, they really do carry lower risk than stocks. So it gives them it makes them reliable when things get a bit choppy in investment markets. And they also give regular income through interest payments, which can really help during periods of uncertainty. Gets a lot more important for those of you who are in pension phase to get that nice consistent income into the portfolios. Those of you that are at least 10 years away from retirement, less of an issue. You can sort of take the ups and downs because you don't have to access your money too soon. But for those retirees, and I've got a few of you sitting on the meeting today, that consistent income's handy. All right, just quickly, Australian Real Estate Investment Trusts have rebounded strongly. Major players like Goodman Group were up 60% last year, but there is a real issue with Australian Real Estate Investment Trusts, and that is that Goodman, aforementioned Goodman there, makes up 38% of the index, meaning the whole sector is really reliant on the performance of one company. For that reason, we got out of Australian Real Estate Investment Trusts right at the end of last year. Basically, just the issue is if you want to be an Australian Real Estate Investment Trust, you're really just taking a bet on Goodman, and we didn't want to carry that risk. In the US, their real estate investment trusts have faced some challenges with higher interest rates or not getting the cuts they expected, but also changing work trends. Work from home is really not great, obviously, for the office sector. But still, look, 16% return last year. It's nothing to get too upset about. Some of the sectors like healthcare, data centers, and industrial property did really well. Looking into 2025, we could see some upside in this part of the market or this asset class if interest rate cuts do continue. Moving on beyond that, infrastructure is a big one for us. Seen a lot of momentum, especially in water, energy, transport. The US government really is increasing its spending in this space. Private investments playing a big role as well, especially in water utilities and transport. So look, the key thing for us in this space is that we think Australian real estate investment trusts carry too much concentration risk, but US REITs could benefit from rate cuts. And infrastructure we just like because it gives long-term stability, especially around essential services. So investors really should consider diversification to balance risk and have a bit of an appetite for this asset class in particular. It's a very heavily allocated part of our balanced portfolios, as I'll show you in a moment. All right. I think the last of the asset classes I want to touch on is gold. Historically, gold has been a great performer during periods of high inflation. It's had its best annual return since the GFC. It's still looking strong though as we head into 2025. Some of you are probably asking, well, why are you getting rid of the gold miners stock? We still have gold, physical gold in the portfolio. So we really like it. We just don't like it quite as much. It's time to take profit. So you can still really love an asset, but just maybe not as much. So look, what's driving the optimism? There's a lot of things happening. Volatility is rising. When you've got a US president that makes sort of rapid fire policy announcements, the market doesn't know what's coming, and that means that it adjusts pretty quickly when stuff comes out. Geopolitical risks are elevated. Inflation's still hanging around. It's not getting down to the lower bounds of where the central banks want it. And the other thing is central banks are buying a huge amount of gold. They're stockpiling it. It sort of happened after the US sort of cut Russia off from global markets. A lot of other central banks sort of thought, well, if our US dollar assets are going to locked up, we'd rather get locked up. We'd rather actually be holding physical gold as a currency, as a reserve as well. So look, these forces are helping offset potential headwinds. A rising US dollar is not good for gold, but look, gold ended 2024 above $2,600 an ounce. Analysts are now forecasting we're probably going to push to $3,000 an ounce in the next year or two. So, when we're looking at portfolios and we want to weather some uncertainty, gold really gives us a nice hedge. We've got some pretty heavy allocations in the portfolios. So let's bring it all together. You'll notice the long-term return forecast across all assets here look fairly modest. Quick little recap on how to read these tables. The yield, so that's your dividend or your income. Currency impact, if you invest overseas and the Aussie dollar goes up or down, that can hurt. Earnings growth, so how much is profit growing, and then valuation effect, is the current PE multiple acceptable or will it come back a bit? So you add all that up and we get the expected return. As you see, pretty sort of modest. Australian equities at 5.4, developed markets at 2.7, emerging markets 5.5, G-REIT 6.6, secure debt 4.3, high yield debt 5.5, fund of hedge funds at 2.7, and cash. But look, what we need to be mindful of here is that this is where the dynamic asset allocation approach plays a crucial role. So rather than just sticking with a static portfolio spread across these things, we do adjust our asset allocations over time. And the reason behind that is that these are average annual returns over the next 10 years, meaning there's going to be better years and there's going to be worse years. So what we want to do is want to take advantage of any market dislocations. We want to manage the risk. We want to position ourselves for higher returns when those opportunities arise. So, for example, in Australian equities, the broad index returns might be around 5.4%, but as we showed earlier, there's other ways to outperform. We reduce our exposure to the banks, we put more exposure into resources. Those sort of things can add over and above the index return amounts you see here. Additionally, we go to international markets or developed market equities as it is in that chart or that table there. Sure, it says 2.7%, but we have opportunity to add to that by overweighting markets like Japan and Europe, where the valuations are a bit more attractive and the corporate reforms are improving profit. Oh, chair just closed on me there. Key takeaway. Look, flexible, diversified approach is essential. Static asset allocation might deliver the forecast returns we see on screen, but actively adjusting our positioning, we aim to really manage those downside risks. We want to capture the opportunities when they arise. Ultimately, what we're trying to do is strive for better longer-term returns for our investors than what you see on the screen. So that's sort of the main things that we're looking at there. Like I said, what does it mean? Look, asset allocation is not an exact science. So the forecast returns are estimates. Risk is complex and markets don't move in straight lines. So that's why we do use our dynamic asset allocation approach. A lot of investment funds, like if you go to industry super funds, they'll use something that's called a strategic asset allocation approach. Other people at the other extreme will use a tactical asset allocation approach. So look, strategic asset allocation, or SAA, all that they do there is make really small, really infrequent changes, even if assets are becoming significantly overvalued. So what happens there is investors get forced to hold and sometimes even buy expensive assets. You've got tactical asset allocation as an option. So that's where really you're trying to time short-term price movements and get both the entry and the exit price into different investments exactly right. The reality is it's extremely difficult to do that consistently. We take a different path with dynamic asset allocation. So we try and ignore a bit of the short-term noise. We focus more on the longer-term trends. So for us, that means we're adjusting our portfolios 2 to 3 years ahead of key events. What it does is it helps us avoid the overpriced assets, allocate capital to better valued opportunities without really having to rely on perfectly timing the market, but also not going as conservative as the SAA approach where you're buying things that might be overpriced. So it does give some opportunities there. I just want to touch on the tipping point tables as well. It's a great way for illustrating how valuations or current valuations affect markets. In short, the more we pay, the lower the future returns we'll get. The less we pay, the better the future returns we'll get. So if we're buying into a market that's already expensive, the less room there is for it to keep going up. So currently, developed market equities are overpriced. You see the side, the little arrow there, developed markets, well and truly into the red territory. Means for the next, for the forecast period, which is the next 10 years, the rate of return on developed market equities is expected to be less than what we could actually get from a term deposit. It hardly makes for a compelling argument to invest there. Global REITs, Australian equities, emerging market equities, fully priced, not quite overpriced, still providing interest returns that are expected to be about 2.5% per annum above term deposit rates. So that's why you'll see in our model portfolios, we're carrying roughly triple to maybe even quadruple our allocation in Aussie equities that we have in US at the moment. Tipping point tables that you can see now on the screen, it breaks it down just a little bit. Still got the developed markets that was on the previous slide, but it does show, okay, well, how much is the US actually the problem there? You can see they're really overpriced. But when you go to the rest of the world outside of the US, we're actually getting fully priced. So they're not cheap, but they're not ridiculously expensive either. So again, it just sort of explains why, okay, you can look at the headline global return thing, but it's really the US that's forecast to be dragging that down. The rest of the world is actually looking a little bit more attractive than that. So how are we positioned at Cooee Wealth Partners? Look, have a look on the left-hand side. We've got the conservative portfolio. At the bottom, we've got cash. You'll see, look, the cash weighting really drifts down as you move across the risk profiles. The more aggressive you get, the less cash we hold, because cash is really a defensive asset. Similar story for defensive alternatives. Defensive alternatives, that is your gold allocation that we have. We then move on to fixed interest. Again, same story. The allocation declines as we move across towards the higher growth investments. We then move to international shares. You can see from conservative through, we increase the allocation as we step up. International shares in emerging markets, again, low allocation in conservative, higher allocations in the high growth portfolio. Property and infrastructure is at its highest allocation of the balanced portfolio. Not quite as risky or as aggressive as the share markets, not as conservative as fixed income. Works really nice for balanced investors to have a good allocation there. And then, of course, fixed interest, that one that you see actually at the top of the charts is the high yield debt. So that's the higher risk side of fixed income. We do break it down just so investors know the difference between what is like a government bond versus a private debt instrument that carries higher risk but higher return. All right, so look, the key takeaway I want from everyone here is really don't go chasing last year's winners. We've got to stay diversified. Opportunities that arise are unexpected. We don't know where they're going to come from. And look, markets are unpredictable in the short term, but over the long term, we do know that trends prevail. So jump in just to the Q&A or the chat. I think there was a couple of questions that came through there. All right, so Bryce, what have we got there? So chatter about how US tariffs might affect Australian markets. Do I have a view on that? Look, not yet. I do understand though that it's kind of look, it's evolving in that space. Discussions the last couple of days between Trump and Albanese around it. So yeah, unfortunately on that right now, I don't have a direct view on how it should affect Australia. Probably the thing we're more concerned about would be tariffs on China and then how that affects China's desire to import Australian resources. So that is obviously a concern, but when we have a look at the current prices in the resources sector, we actually think that a lot of that negativity is already priced in into prices. So we're quite happy with that. We've then got one, what do you think about cryptocurrencies? I think this comes up every time. Look, our issue with cryptocurrencies is we see it as being sort of purely driven by sentiment, right? It's a very hard thing to fundamentally value. So we like to look at something and go, what is it actually going to earn us? If we buy it today, what income do we get? How much is the profit going to grow? What can we sell it for in the future? With cryptocurrencies, it's impossible to apply any of that. So where it unfortunately leaves us is speculating. And I'm not comfortable doing that with client money to speculate or take a guess or take a punt. I need something that we can actually work out and go, are we comfortable owning this, rather than, look, I can see its take up being something of appeal, but how do you value it? That's the big challenge. So that's really the big issue we have there. If anyone else has any questions, send them through. Otherwise, if not, thank you all for joining me. If you've got any comments, feedback, anything you'd like to see in future presentations, send me an email. Happy to put together something. What we probably want to try and do in our next presentation is one around the property market outlook, because most of our clients have got exposure, obviously through your homes, but also investment properties is obviously a key part of everyone's wealth. It's actually the largest investment asset class in Australia. So I think that'll be the next one we run. Thanks everyone for joining me, and yeah, I hope you got some value out of it. Thank you.